Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Private Equity, Scale, and Strategy, Inside Kestra with its CEO, President, and Private Equity Partner. It's a conversation with James Poor, CEO of Kestra Holdings, John Amor, President of Kestra Financial, and Fayez Mutadi, co-head of Private Equity at Stone Point Capital. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
As advisory practices grow larger and more sophisticated, the definition of success is shifting. For many advisors, it's no longer just about income or payout. It's about ownership, alignment, and building something that carries real enterprise value. That shift raises important questions. What does scale actually enable? How should advisors think about capital? And what does alignment really look like between firm leadership, capital providers, and the advisors they serve? To explore that, I sat down with 3 people who see this from different vantage points. James Poor leads Kestra Holdings, John Amor oversees the strategy and execution behind Kestra Financial's growth, and Fayez Mutadi represents Stone Point Capital, Kestra's private equity partner. Kestra today operates one of the larger independent wealth management ecosystems in the country, supporting roughly 1,450 advisors and overseeing more than $160 billion in assets across its broker-dealer and RIA platforms. Stone Point, for its part, is a financial services-focused private equity firm with decades of experience investing in banks, asset managers, insurers, and wealth platforms. Together, they represent a scaled, privately backed model that has become increasingly common in our industry. In this episode, we unpack what multiple ways to win actually means inside a platform of this size. We discuss the positives and common misconceptions surrounding private equity ownership, how cultural alignment can be preserved as firms grow, and why James believes this business is not an income game, but a wealth game. If you're evaluating scale, ownership, or long-term enterprise value in your own business, this is a conversation worth hearing. So let's get to it. John, James, and Fayez, thank you, all 3 of you, for making time with us today.
Thank you, Louis. Thanks for having us.
Fantastic. Let's go round robin real quick. And if each of you can just walk us through your backgrounds. Maybe let's start with James, then John, and then Fayez.
Sure. Thanks, Louis. I have actually been with every form of Kestra since 2003. And in fact, last week was my 23-year anniversary with the organization. And prior to that, I was at actually what is now the Advisor Group, or Osaic, and just grew up in the wealth management industry.
Fantastic. And your role today at Kestra?
I'm the CEO of Kestra Holdings.
Amazing. John, you're up.
Great. So I entered the wealth management industry out of business school, and I started at UBS, and for 14 years was there, always running wealth management businesses, sometimes leading advisors, sometimes leading products, platforms, but always wealth management businesses in the US, in Latin America, and in Europe. And then I joined Kestra at the end of 2019 to run the wealth management business. And then last year in April, became the president of Kestra Financial.
Thank you for sharing. Fayez, you're up.
I have been in financial services my entire career. I graduated from The Ohio State University, spent 8 months at Aon Capital Markets, then moved to New York City, where I was an analyst in the financial institutions group at Credit Suisse. I spent 3 years in that group, and then I joined Stone Point. At the time, it was called MMC Capital, and that was in 2003. And when I joined in 2003, wealth management was the sector where I was spending the majority of my time, looking for partnership and investment opportunities. Today, I'm the co-head of our private equity business. We actually have three businesses that sit under Stone Point. So our largest and core business is financial services private.
Perfect. I'm going to go a little bit out of order to the way I was going to go, but since you're just talking about the organization of Stone Point, for those who maybe aren't as familiar, can you just give the 30,000-foot view on what the firm does, maybe some of its achievements or stats or anything, just to give us all a better perspective of how Stone Point operates within financial services, but also works today with Kestra?
Yeah, great. Be happy to. We focus exclusively on investing in the financial services industry, and we've been doing that for more than 30 years now. So across multiple market cycles, that focus has really allowed us to develop deep domain expertise. So across insurance, asset and wealth management, banking, and all the related sectors. Our investment philosophy is actually pretty straightforward, even when executing is not always straightforward. But we look to partner with businesses that share a few core characteristics. First, we are drawn to industries that have strong secular tailwinds. So areas where we see long-term structural growth that can support value creation over time. Second, we focus on durable businesses with multiple ways to win. So that means business models with resilient economics, recurring revenue, rather than just reliance on a single growth lever. And third, and very importantly, we partner with companies that are led by exceptional management teams. So people who not only have strong operational capabilities, but who also really share our core values around integrity, long-term thinking, and stewardship. And then lastly, we're always looking for situations where we can leverage that specialization in financial services, where that experience, those insights that we've accumulated for over 3 decades can really help management teams accelerate growth, improve execution, and ultimately create value for customers, employers, and shareholders.
Well said. Let me ask you two quick follow-ups. The first one is it unusual in the private equity world to have one industry or one sector that the entire fund is focused on?
I would say it was unusual going back maybe 20 years, 10 years. I think there has been a realization that specialization and having deep domain expertise within a particular industry can really differentiate in the market. And that comes not only from sourcing investment opportunities, helping to create value while you're an investor, but also on the back end when you're looking for creative ways to monetize. And so I think what we are seeing in the market are firms trying to create that specialization, whether you have firms that focus on industrials, energy, technology, software. But when it comes to financial services, I would say that we're the largest global player. We're currently investing out of our 10th fund. It has $11.5 billion of committed capital. And so within the world of financial services, it is unique.
Amazing. What are some notable current and past investments that Stone Point's done? We'll say within wealth management. That's probably the vertical that most of our listeners are most familiar with.
Well, we actually made our first investment in 2012. So we were fairly early to the space. It was a minority stake in an ultra high net worth business in Boston called SCS. And since then, we've committed almost $6.5 billion of equity capital to the wealth management, but this sector more broadly defined. So we've invested in firms like Focus Financial, IonQ, of course, Kestra, but we've also invested in areas that are adjacent to wealth, like retirement. For example, in 2021, we invested in Ascensus, which is a leading provider of technology-enabled services to the tax-advantaged savings market. So a lot of similarities to core wealth.
That's a heck of a resume. Some incredible firms, and now Kestra. So let's pivot back to Kestra. John, for advisors who may not know Kestra as well as you hope they would, how would you describe Kestra today, the different businesses and the overall ecosystem that you and James are operating today?
We serve very advice, planning oriented, independent advisors. who still have this growth mindset and are particularly looking for being served in a boutique way. And I'll define boutique way as advisors know us, we know them, we care about their growth, and there's a partnership there, whether they're doing commission business or fee-based advisory business. We're mostly advisory business, but we support the complete wealth management set of needs. And we do that for two channels, really. One, traditional independent advisors who are usually leaving another independent type of broker dealer or wealth management firm. And then our Kestra Private Wealth Services caters to people who are coming from captive environments. My colleagues, Rob Bartenstein and Scott Wilson, started that business some years ago and have really created a nice exit strategy for advisors in wirehouses or captive environments. And we serve them like any other independent advisor, but create a glide path for them to create their own independence outside of sort of captive environments, banks or wirehouses.
Terrific. Thank you for sharing. James, because you said you just celebrated your 23rd year with Kestra, you've been along for the ride. Can you talk briefly about Kestra's journey and evolution? Like, I remember first knowing Kestra when it was NFP and then it became Kestra, but there's definitely a couple chapters before and after. So can you just walk through how you got to where you are today?
Yeah, for sure. I remember meeting you for breakfast many, many years ago in New York City.
I feel important. Thank you.
Yeah, thanks, Lewis. It's been an incredible journey, and on both, just a personal and professional standpoint, just something that I have enjoyed immensely. There's a few foundational things that I think have been important for us. Number one, we have had the good fortune of fantastic investing partners like Stone Point, who are very focused on helping us build and deliver enhanced value into the marketplace, which has empowered us to really focus on a very select total addressable market of sophisticated, growth-oriented wealth management firms. We have delivered enhanced value both through service, through technology. We've built an outsourced CIO. We've built and acquired an insurance platform. We've acquired a trust platform. We keep rounding out everything needed to deliver that complete wealth manager platform, which we are very focused on. And we've done it in a way that is true to the discipline we set out of staying focused on, don't try to be everything to everyone. And we've had great success in our three channels, which, as John mentioned, is traditional independence, wirehouse extras through Private Wealth Services, and then through our acquisition engine at Blue Spring Wealth.
Perfect. And I should have asked leading into it, but if you're comfortable, can you share just some stats on the business? How many advisors does Kestra service? Anything about the amount of assets on the platform, et cetera?
Sure. We have about 1,450 financial advisors. We oversee, I think, around 160 billion in assets. We have a uniquely high average production per financial advisor, and 90% of our revenue is recurring. So we're not an IBD, Lewis. We are a massive RIA wealth management platform, and we have a broker dealer if you need to do a trade.
I like that. I would agree with you. Whenever I'm thinking of Kestra, like what sticks out to me is a couple of things, but you hit on one of the biggest, which is the average production per advisor is far above the typical average in the industry. So for a more mature kind of ensemble practice, Kestra tends to resonate.
On quality, not quantity.
Perfect. John, question for you. From the independent advisor seat, what problem do you believe Kestra most deliberately solves better than your peers? And obviously, you don't have to name names, but speaking more from a position of strength, what does Kestra do better than others in the industry?
There's two reasons why advisors come here and stay here. And one is we have the capabilities to support all of their wealth management needs that they're trying to solve for their clients. Investments, planning, insurance, all the solutions they would need to be a complete wealth manager, we provide. And then secondly, we create a community of people that advisors are excited to be a part of. And we play big, but we feel small. And there's a lot of advisors who appreciate that. We just had our national event last week, and our advisors are excited to come and see each other and see us here in home office. And so for those people who value relationships with other advisors, with peers, people they can learn from, as well as relationships with home office, That is what our advisors tell us why they like to come here and like to stay here.
Yeah, I like that. It's big in the areas that matter from a resourcing platform standpoint, but it doesn't feel massive, which I think is a much needed thing or element of the industry today, given all the broker dealer consolidation and Commonwealth being sold, et cetera. So I think it's a great spot that all of you occupy.
Yeah, I agree. Like, look, so many people got into this business because they believe in the power of relationships, right? And so that is alive and well here. And we got into the business for the same reasons and are happy we've been able to create that kind of community.
Perfect. Let me ask John follow up, and then James, I'll give you the same question. What do advisors often misunderstand about Kestra when they first evaluate the platform?
Yeah. So, it's interesting. When I joined Kestra, we weren't as well known of a brand as we are today. And there are still some people, when they uncover who we are and what we can do for them, they're always a bit surprised about how big we are in terms of capability. So I think they're always happy to know that we can meet them wherever they need to be in terms of private markets or advanced planning or high net worth solutions. That we offer a lot more than people expect. So that's why we encourage people to come down to Austin to get to know us. And so I think that is probably the biggest surprise for most advisors.
Perfect. James, anything John missed or you wanted to elaborate on?
Well, I think John's answer was fantastic. The only thing that I would add is that I think advisors are always pleasantly surprised to realize how much we focus on helping them create enterprise value.
That's a good one. Ultimately, that's what pretty much every advisor is in this business for. I mean, some are doing it for out of the goods of their heart, but they're building something, taking entrepreneurial risk to maximize their enterprise value. Even if they never sell it, everyone's looking to figure out ways to create different offshoots of optionality. Fayaz, I want to involve you in the conversation. So what originally made Kestra an attractive investment to Stone Point compared to other independent wealth platforms? And I'm sure given the scope of the firm, you're in the deal flow for pretty much everything. So what was it about Kestra that really stuck out to you?
Well, at the risk of sounding a little repetitive, I do want to maybe reinforce some of the points that were already made. What initially stood out is just how complete the business is. And so when you think there's three parts to that. So there's the foundation, right, which is the financial fundamentals. So consistent organic growth, high levels of both advisor and client retention. It generates meaningful free cash flow. It has an impressive track record in M&A. So very successful at attracting and partnering with some of the highest quality RIA and hybrid firms in the country. But then you take it down another level, and what really differentiates Kestra is the breadth and the quality of the platform and how it's positioned in some of the most attractive pockets within the broader wealth management landscape. So John talked about Kestra Financial, right? It serves a highly sophisticated advisor base, provides them with independence, flexibility, and support so they can grow their practices, right? You've got Blue Spring, so that's another compelling part of the ecosystem that offers interesting partnership opportunities for those who are seeking a more permanent capital long-term ownership solution. And then there are all the value add capabilities that James mentioned, right? So the outsourced CIO, the insurance agency, all of those are truly best in class, and it's really integrated into the advisor experience. And then the last piece, which is truly unique, really it's the management team, right? And the talent. And I mean this in all sincerity, it really is a privilege that we have the opportunity to partner with them not once, but now for a second time. We really do share a common vision about where the business is going. We're aligned culturally, we're aligned financially. And that alignment, by the way, extends throughout the entire Kestra ecosystem. So independent advisors are not just participants on the platform, but they're owners of the equity alongside all of us. So that really reinforces this long-term partnership and shared success philosophy.
Very interesting. So you mentioned, and I completely forgot that this is Stone Point's second investment into Kestra, which I guess it means you guys kind of like each other and had a pretty good experience the first time. So, I mean, can you just talk about the decision of coming back in? I guess first going back out a couple of years ago and then coming back in.
One of the things about our business is that we are not permanent capital. We are temporary capital. So we are forced with the decision to provide liquidity to our limited partners at some point throughout the journey. And that, comes, it varies, but it comes sometimes after 3, 4, 5 years, or sometimes a lot longer than that. But it really depends on where the company is in its growth journey. And so, coming out of NFP, it really is remarkable the job that James and team did in creating a lot of value in such a short period of time. And so it was just a prudent thing for us to do is to, sell as a substantial portion of our stake. We sold that to Warburg Pincus. And under their stewardship and under John and James's leadership, it is remarkable just how developed and matured the business has come since we sold the business to Warburg. And so when we looked around, maybe starting with your earlier question, what makes it attractive or unique relative to other independent wealth platforms, you sort of do that analysis, and there's no other company we'd rather partner with in Kestra. And so that's what led us to, come back to partner with James and John and team. And I will say, one of the biggest risks to making investments is making sure you have that cultural alignment. And that was like one risk that really wasn't part of the equation. Having been through the journey once before, James and I have stayed very close throughout the years, even when we were not an investor behind Kestra. And so that important element of any transaction, of any deal, simply just wasn't existent. It was like family.
Right. Thank you for sharing that. And I also was thinking too, when you were describing some of the core tenets of Stone Point and what you look for in investments, you said multiple ways to win. And it's very clear that's the case with Kestra, where you have the acquisition arm, which is Blue Spring. You have the recruiting machine of Kestra Financial and Private Wealth Services. You go after independent advisors, wirehouse advisors, existing RIAs, and then you layer in the trust services, the insurance, the investment platform, et cetera. So you do have a very all-encompassing opportunity here. Let's make this a little bit more interactive. Fayez, definitely have a bunch more questions for you, but I want to flip it back to James. In your view, how should a prospective advisor or recruit think about the fact that Stone Point will not be invested in perpetuity? As Fayez just said, it's more of a temporary solution than other types of capital. And even if it's the best relationship in the world, eventually the fund has to provide liquidity to its LP. So how should an advisor think about that?
Yeah, that's a great question. And it certainly comes up occasionally in recruiting and acquisition discussions. Here's how I explained it, and this is how I view it. First, we have been unbelievably fortunate in the private equity investors that we've had, starting with Stone Point. Fayez mentioned Warburg Pincus. Oak Hill has been an incredible partner, and now another round with Stone Point. What we view investors as a chapter in our book, but we are the book, we are the story. We are the perpetual organization that seeks a deep, thoughtful relationship with an established wealth management leader or business to help create greater value for them. That is who we are. That is what we are. We will manage those chapters throughout the book as we read it, but we've proven pretty good at doing that. And we've also gotten this organization to a point where we attract literally the best investors in the world who want to be a part of this organization. So we're able in many ways to build a destiny moving forward that creates a lot of opportunity for us, for investors. And as Fayez mentioned, a lot of our advisors have come along as investors in the company. So we have this incredible alignment end to end because of our relationship with Stone Point and other private equity firms. What it has done is created more opportunity for everybody involved.
Interesting. John, anything to add?
The great thing about our investors is that they know the essence of who we are as a company and have been really helpful in helping us be better versions of ourselves. And those are the types of private equity investors we value. They've only made us better in this journey, and we've been remarkably true to who we are as a company, as Kestra.
Perfect.
Let me add one more thought to that. And since we have Fayez here, we can put him on the hook to validate this. High quality private equity firms, they acquire firms like ours, not because they want to do something with us. There's this misunderstanding in the marketplace. And sometimes when we've announced a transaction or a recapitalization, someone will ask me, well, what are they going to do with you? They're not looking to do something with us. What they're investing in a management team, a business strategy, a company that has multiple ways to win, and a business that executes in a sector they deeply believe in. And then what they want to do is help us accelerate and improve that execution, making us a better company. So I think that's a misunderstanding of the marketplace. And so that's how I view, again, those chapters in the book.
Perfect. Yeah, Fayaz, I was going to ask you, from your standpoint, what's the biggest, or what are a few misconceptions that folks typically have about private equity investing in companies, and maybe something that actually is true that you'll concede or admit?
Yeah, it's probably a fairly long list of misconceptions. So maybe I'll hit you with a couple. So there's certainly this one that private equity is just money, and in reality, not all private equity firms approach partnerships the same way. So firms that focus on financial services, they understand it's a nuanced, people-centric business, and in those cases, the value of the partner, right, can often bring benefits well beyond just the capital. So it's around just the business knowledge. It's leveraging that pattern recognition from prior investments, lessons learned from both successes and mistakes across market cycles. And so hopefully there is some business and knowledge base that is being enhanced by partnering with private equity. The second, and it ties to your prior point, Lewis, around just sort of timing and being temporary, not permanent capital. But this notion that private equity is inherently short-term oriented, right? Focused on maximizing near-term earnings at the expense of long-term franchise value. We don't subscribe to that at all. And while that may be true in some cases, we strongly believe that sophisticated future investors are generally able to see through businesses that have been underinvested in or have been artificially optimized for short-term profitability. So for us, achieving a strong valuation today usually depends on demonstrating a credible path to value creation for the next owner. So not just maximizing the current owners, what are the investments that you've put in the ground that are going to bear fruit in the future? And so that's how we approach partnership. It's both short, medium, and certainly long-term.
Perfect. I think it's a really smart and articulate viewpoint. And I would imagine that there's probably competitors that you won't name or deals you've seen where what you're saying actually has been the opposite, where a private equity firm did come in and did try to impart their will and cut costs and boost the EBITDA. But I guess it matters that the quality of the PE firm, their body of work, their track record is seemingly more important than just the fact with a broad brush that it's private equity.
Yeah, and that one probably is one of the real risks, right? We always encourage the partners that we are about to invest with to do as much diligence on us that we do on them, because that partner fit, I know I've been beating this sort of cultural and sort of talent drum, but that is a real risk, right? You really want to make sure you get that cultural alignment, the shared vision, the governance, and misalignment across any one of those areas can really undermine what would otherwise be a successful investment. So you really have to take your time during that due diligence process and make it two-way, and we strongly encourage that.
Perfect. James, I got two similar but different questions for you. First one is, can you talk about Kestra's decision to be private equity backed? Not even just, we had one private equity investor, but it's been a pretty long and storied history of being invested in or owned by private equity versus the decision to be a publicly traded firm. And we won't name names, but there's obviously a handful of large competitors that are public, far fewer now that are private, now that Commonwealth was sold, and a good number that are private equity owned. So for you as the CEO and steward of the business, can you talk about the decision to be PE funded versus public?
Look, I just feel like we are, especially at this point in our organization, and it's been a long point, we're just better suited to be privately held. We're able to be very nimble with a thoughtful, vested board of directors that thinks long-term in terms of the necessary investments, both in, technology, talent, everything that we need to do to continue to be that next level organization, we're able to achieve in private ownership. And I like how agile that it is and how empowering it is. And that's what's really always led me to really be an advocate for private equity, not only in our space, but also for this organization.
Perfect. I mean, you don't have dreams of being on analyst calls and releasing quarterly earnings.
I listen to analyst calls occasionally, and it's dream isn't the word that comes to mind.
Love it. I think an important question. My guess is in pretty much every recent recruiting conversation, this concept has come up. So last May or April, I think it was, Commonwealth Financial Network, probably the best known, purely private, non-private equity owned broker dealer, kind of out of the blue, announced that they were selling to LPL Financial, the largest independent firm in the space, maybe just a little bit. So given that sale, obviously there were and there are a lot of Commonwealth advisors exploring options, but even for non-Commonwealth advisors, people just see that transaction. And I think it kind of sparks in their mind, like, okay, you're like, why isn't the next one to get sold? So especially with the more temporary investment from Stone Point or private equity, how would you help an advisor square or reconcile that fact that even Commonwealth, which was always the staunchest believer in being private and not being part of a large company, if even they are on the block and were eventually sold, why isn't Kestra the next domino to fall?
Lewis, that's a tough one. First, I honestly feel that capital structure of an organization should not be one of the key decision points for a financial advisor in choosing a partner. Who's going to serve your business best? Who's going to create cultural alignment with you? Who's going
Yep.
to help you truly build a better business? I think those are the important questions. Capital structure among the competitive set typically only gets brought up in those recruiting conversations because recruiters are looking for that edge, right? Well, I could sell against a publicly traded company or a completely one single individual owns the company all day long. One's going to have succession issues they eventually have to solve. Who knows what's going to happen? The public one, we could sell against them by saying that they have to slay the quarterly dragon. They can sell against us by saying, you don't ever know what's going to happen. In reality, first, I don't think any seasoned, thoughtful, experienced, honest CEO is going to be able to tell you, I know exactly where this company is going to be in 10 years because the market is always changing and evolving. I think you have to look for the right sort of connectivity and relationship there, and then trust in it and make sure that it works for your business moving forward.
Yep, well said. I completely agree. Ownership structure of various firms, it always comes up. I feel like 5 years ago, it almost never came up. But just given the list is very long of all the acquisitions across the space. It is on advisors' minds, but I always say that there isn't a right or wrong ownership structure. Like you articulated many of the pros and cons. Like I completely agree with you. It should be more about the culture, the support, the pricing, the resources, et cetera. And no one knows what the future holds. I mean, we see publicly traded companies get sold. We see privately held companies get sold, private equity companies selling their portfolio companies. So I'm with you. It's the only definitive thing is no one knows what's going to happen next.
The only thing that I would add to that is this, and that is that we have intentionally built this organization, its revenue streams, its earnings streams, its diversity of ways to win and income and earnings in a way that I think uniquely empowers us to have more control over our destiny than some other competitors in the marketplace. That does make us unique. That's super difficult to get into in this format, but it is a fact about this organization. We are not a one-trick pony, is the best way of saying it. We have multiple, thoughtful, high-quality earning streams at this organization versus being overly dependent on a more volatile one where many of our competitors sit.
Perfect. Got a follow-up question for James, John, and Fayez, you can jump in if you'd like to. But I think at this point in time, like ownership structure of a firm is a hot button issue, as we just talked about. But I feel like scale, that word, that 5-letter word, is omnipresent. And really any conversation I'm having, probably you're having too. And just what's the scale of the firm? And scale or lack of scale is causing a lot of the M&A activity for RIAs, for independent firms, et cetera. So I guess I'll start with John. What does scale mean to you? And how do you think scale relates to Kestra Financial overall?
Scale means us having the right balance of curating a community or a size of business that we can support in a very tech forward, service forward way, and where we're not dependent on adding advisors to our business to keep it growing. We're able to sustainably keep serving the advisors we have and be thoughtful about how many advisors we want to or don't want to add to our business and be able to still make our firm better every year and meet our advisors where they are at any given point.
Great answer. James or Fai has anything to add? That's hard to follow.
Yeah, I like his answer. There's one thing that I would add, and that is that when I get asked about scale in this industry, Lewis, the first thing that comes to mind is how so many of our competitors are scale focused. They're scale players. They're trying to cram as much into a bag as absolutely possible. We currently have, just because of the size of assets that we have some benefits of scale. We will continue to benefit from operational scale, things like that over time as the company continues to mature. But we're absolutely doing the polar opposite of the scale game because to John's point, we are quality, not quantity focused. We want deep, lasting, long-term relationships where we can help an advisor through that entrepreneurial life cycle, potentially all the way through succession and monetization of that business.
Yep.
Again, it is a unique environment. It is an environment that sets people free out of the wirehouses and helps them build their own brand and their own enterprise value. And we just take a completely different advisor-centric view into the marketplace, which often means we're not just cramming bodies in to achieve scale.
Makes sense. Fai has anything to layer on?
Yeah, maybe just one comment. In search for scale, there can be this temptation to overly rely on M&A and really accelerate M&A. And that can be a powerful value creation tool, right? It can add diversification, can expand our geographic reach, introduce new capabilities. However, successful consolidation does require a commensurate investment in operations, technology, compliance, and cultural integration. And so my only comment on scale is when the acquisition velocity outpaces the integration capacity, that can really undermine the benefits of scale for the initial pearls.
Interesting. I'm tracking with you on all three of your perspectives, but to play a little bit of devil's advocate, that's what we're here for. What would you say to some of your competitors who talk about the $1 billion that they spend on technology each year and how they can use their scale to invest in new AI tools, et cetera? So, I mean, obviously, it's not rocket science. If Kestra is a fraction of the size of some of the larger publicly traded competitors, naturally, that means that the budgets and the amount of money to spend on specifically technology is going to be quite different. So how would you critique that viewpoint or respond to that?
I'll take that first. And then, John, if you'd like to add, please do. Where an organization of that size is having to make investments is completely different from our organization. So we clear and custody through Fidelity's NFS business. If you take any large, public entity that is self-clearing and so on, so much of their technology investment has to go into services that we actually acquire in a partnership with Fidelity or other vendors. So they're recreating constantly, through my eyes, wills that there's better solutions in the marketplace. So where we are investing our dollars, and we spend hundreds of millions of dollars on technology, where we're investing ours, again, is at the very point of success for that advisor and their client. We're going through a substantive investment right now to continue to advance and evolve that. So I would rather our dollars be invested in that advisor and client experience, bringing the best that the entire marketplace has to play and to integrate, rather than going out and rebuilding every sort of system out there that an advisor may need. So I think that it's actually a better solution for advisors.
Yeah. So it sounds like it's the decision to rent components and to build components and making the decision of what can we invest in that's going to be a differentiator or a key part of our value proposition versus what's more of a utility or something that isn't necessarily worth building ourselves.
Exactly.
Makes sense. How about just the difference? Like, again, another hot button kind of differentiator that folks use these days to evaluate firms is the self-clearing firms versus the third-party clearing custody firms like Kestra is. Like you said, clearing through and custodying with Fidelity versus an LPL self-clearing, Raymond James self-clearing, Ameriprise self-clearing, et cetera. What do you think, aside from the tech spend, are the pros and cons of a self-clearing versus a third-party clearing firm?
John, do you want to take that or you want me to take that?
Well, why don't you start and I'll
Sure.
Yeah, go.
I don't think there are any significant advantages to one or the other. Again, that is simply not, in my opinion, where an advisor should be focused. That's a recruiter's sort of little selling point. It's not what's important. What's important is, what are they delivering to me and my staff? How are they helping me deliver a great client experience? What is the culture? Am I welcome and I encourage? Am I with a group of people that I learn? Do I go to a conference and sit next to someone who actually has a business that is, tens of millions of dollars larger than mine? Or is it someone who's hoping to sell 70 grand in annuities this year because there's so many advisors at this company? Again, we're going to provide that high quality boutique feel, that high touch. You're going to be playing tennis with people as good as you or better, and you're going to learn from them. I don't think those back office components really should matter that much to a financial advisor.
Good perspective. John, what would you add?
I spent the first part of my wealth management career at a wirehouse, so a self-clearing firm. And it's been interesting being now at a firm that uses a third party for clearing. It may be nice to say you self-clear, but trust me, the legacy technologies that come along with self-clearing and the complexity of managing that is not light. And whereas, we choose to partner with the firm that's constantly needing to be competitive as a clearing firm, and we get the benefits of Fidelity competing in an environment against other clearing firms versus self-clearing where you're constantly trying to invest to keep legacy technologies current, which can become challenging.
Interesting. Yeah, I think one of the common, pros of self-clearing that I hear often is our technology and our platform is better integrated because we build everything specifically for us. Do you see any of that being true, or is it just a matter of how good is your technology integration with, in your case, Fidelity?
It could be true sometimes, but it's not consistently always true. Look, integrating with other technologies is fairly normal now, right? And sort of API developments, integrating with our whole industry is just getting better at this every year. And so I don't know if that's as true as it used to be. So the ability to choose best in class tech partners as you need to at any given point creates a lot more freedom and agility for us, especially when serving independent advisors.
Yep. Thank you for indulging, we'll say, my hard-hitting questions. Thank you for taking them like champs. I'm sure that's not the first you've been asked it and not the last, but I really appreciate your perspectives. Let's talk a little bit more on, we'll say, the playing offense side. Really for any of you, maybe I'll start with John. Since you joined Kestra in 2019, how have you seen recruiting conversations materially change? Like, what are advisors valuing differently now than before the pandemic? What are some big changes that you've seen?
A lot has changed around us in this time. When I first got here, there were a lot of wealth management businesses that were like a side priority for a company, typically an insurance company or maybe an asset management company that happened to have a wealth management business on the side. And the advisors in those places learned that not being a priority led to it not being a good home for them anymore, right? So for the sophisticated firms that wanted access to the right technology, the right wealth management capabilities, they needed to go to a place that was truly focused on serving wealth managers. And so I think we've been able to attract advisors who are at places like that. The other thing that's changed is with all the consolidation, there are some really big firms. And there are a lot of advisors who don't want to be one of 30,000 people. And there's less firms like us now out there that can have that, who want to be at a place. I always like to say, we're happy to be the David in a world of Goliaths. And there are advisors who want to be a part of that because they've learned that, hey, the community matters, the relationship with home office matters. They want access to James and to Fayez and to me in a way that we can be supportive of what their size, that we do that all day, every day. And so these are the types of conversations that recruits are looking to have with us and what they value about us.
Fantastic. Fayez, from your perspective, being right in the fray of all this consolidation happening across the industry, John just alluded to one of the, I'd say one of the past trends, because there aren't really any insurance owned BDs like really left. There's a handful of, for whether it's independent broker dealer or RIA consolidation and M&A. What inning do you think we're in? Is it the bottom of the fourth or is it the top of the ninth?
Wow, you want to go that specific, not just the inning, but whether we're the top or the bottom. I wish I could answer with that level of specificity. The pace that we have seen over the past several years certainly feels like we've set a new normal, right? Which would suggest this is not a late cycle spike, right? When you see this pattern where every year, we're setting a new record, right? Which means that even if you pull back from where we are currently, we're still at volumes that are significantly higher than where we were several years ago. And a big part of that is the structural factors at play here, right? So, succession, scale economics, professionalization, the depth of the buyer base of investors, the shift towards independence. Those things really feel structural. So it feels like we're in mid innings, right? It's certainly a lot more competitive than it was several years ago, but it certainly feels like we're not late cycle at this stage. On the IBD side, I have less familiarity because we're not an IBD. We're a wealth manager, as James pointed out earlier in the show. But that space feels like it is already consolidated, right? But I don't know, integration, advisor breakaways, regulatory cost. There are certain factors that can continue to keep this consolidation flywheel spinning. So we're probably in later innings on the pure IBD side, but it continues to be fragmented. And so room for consolidation there as well.
All right. So bottom of the fourth, 2 outs with RIAs and
Exactly.
top seventh with the lefty warming the bullpen for IBDs.
Oh man. Let's try a football analogy next time, please.
All right. So James, I'm going to toss the ball to you here. Do you view the fact that there's fewer independent broker dealer competitors as a positive or a negative for advisors these days?
It's a positive. I've grown up in this industry and there were simply too many. There's still a lot of options. So by no means are the advisors being limited in their optionality. I think there's a good, strong separation, differentiation of approach and value proposition in the marketplace that gives advisors a lot of options. I think it's quite healthy where it's at right now.
Perfect. Good answer. And James, one more question for you. What's a strategic bet that you're making at Kestra today that won't be obvious to advisors for a few years? Or maybe what's a project that you can talk about that you're particularly excited about that might take a little bit of time to realize?
When we make investments, and we're making a lot of them, we always try to find both short and longer term benefits. We've just learned that it's better off to deliver some first downs, just to keep it first to the sports analogy. Let's deliver some first downs that impact the advisors and their staff and their clients as we go down the field to try to score that touchdown. So first, we're delivering on some pretty solid first downs this year. I think the longer term one that's going to come to more fruition over the next few years that I think I'm most excited about is what I refer to as the weaponization of data. What we're doing right now with data in our organization will not only empower us far more as a management and leadership team, but it's going to be really impactful to the financial advisors, wealth management firms that we serve in terms of their ability to look into and understand their client base in a far deeper way, and up to and including empowering them to have better conversations earlier in cycles and opportunities that will just help them build a more valuable business and will help them serve their clients in a better way. So I really think ultimately the data empowerment and the work we're doing there is going to bring a lot of value.
I know you didn't say AI, so you have bonus points for originality.
Thank you. Well, AI is a component of that. Having good, strong, clean, dependable data, you can do a lot with before we even start deploying a lot of AI tools. But for sure, that will come into a play.
Agreed. Let's just do one more round robin question. What's a really good question that any advisor or successful business person should be asking themselves right now that they often don't? We'll start with Fayez, and then we can go to John and wrap up with James.
Hard to pinpoint any single question. I sort of go back to the point that I made earlier, we find that sellers of businesses don't spend enough time doing the reverse due diligence. And so there's a whole host of questions that come out of that work stream. So as opposed to one question, I think it's just this mindset that just because you're the seller, it doesn't mean that you shouldn't be doing due diligence on the buyer. And whether that means you're going to be an equity owner in the future, or maybe you're even retiring, but it's also your legacy you're presumably trying to protect and preserve. And so I would just encourage those who are looking to make these important life decisions to really understand their partner, make sure that that cultural fit is there and that long-term vision is there.
Love it. I'm with you. It always seems counterintuitive that a lot of times equity is part of M&A transactions or deals, and advisors will spend a lot more time analyzing the meta stock movement for the last year or their equity in their company that they're currently at, but far less time really analyzing the privately held equity that they might get as part of a transaction. I think that's very smart. How about John and James?
Similar to what Fires was talking about, like, how do you improve the sustainability of my business? How do you help me think about succession planning? How do you help me think about the next iteration of the firm that I have built? And there are a ton of demographic shifts happening in the wealth management industry. So how do you help me connect with those people who are inheriting wealth? We all know women are inheriting wealth at unprecedented rates. There's a whole bunch of Gen X people that are going to be inheriting wealth who are looking to have a different conversation, a different wealth management conversation than their parents. And so how do you help me address that, the next version of the wealth management industry?
Perfect. Last but not least.
Sure. Thank you. The most important question advisors should be asking is, how will you help me create enterprise value as an entrepreneur? And I think it's incredibly important. We have been so successful with this, Lewis, especially with the Wirehouse Exeter crowd and private wealth services, helping these financial advisors cross that bridge from one of the large banks to actually building their own brand, their own company, their own personal enterprise value, not just becoming part of someone else's brand, but really building their own company that they can perpetuate, they can monetize. It is empowering beyond just being a high earner. And that's the thing we really want people to understand. We are geared for this. We are built to do this and deliver this in a way that is very unique in the market. And I think we've done an exceptional job. And I think that's a question, especially among our Wirehouse brethren, that doesn't get asked enough. Is not an income gain. This is a wealth gain. And that's something that we focused on that we're very good at.
I love that. I'm tracking with all of your answers, but James, what you said is near and dear to my heart, because I think that is a massive shift that we're seeing. There's still plenty of people that chase the current income of a deal or what's my payout. But I'm seeing, even with Wirehouse folks, that they're really stopping and thinking about what's really the value of what I've built. And is there a way to get a multiplier on this value over the long term versus just moving from note to note or staying put? So I love it. All three of you, thank you so much for joining us today and hanging in with me for some of my probably annoying or frustrating questions. But I honestly think like these types of conversations are so beneficial to advisors, people in the industry, because you get a real insider's look into the way you're kind of interfacing with all these different dynamics in a completely different way than others might perceive it. So my biggest takeaway was multiple ways to win, just the way that each of you described the relationship with private equity, why it's actually a positive in many cases, not a negative, and just overcoming some common misconceptions about Kestra. So this has been terrific. I appreciate all of your time today.
Been good fun. Thank you, Lewis.
Yeah, thank you, Lewis. Appreciate you spending time with us.
Thanks for having us.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.